This video is called Predicting FOMC Rate Decisions, the Magic Indicator. The Taylor rule has traditionally been the go-to indicator or guiding light for how the central bank adjusts the nominal interest rate in response to changes in economic conditions. We present another indicator that is actually more accurate and relies on none of the assumptions required for the Taylor rule, and when combining our indicator with a revenue measure gives useful insights into the challenges facing the FOMC. So this is the indicator. We look at non-financial assets at historical cost of only non-financial companies. What these assets are referring to are tangible, productive assets, which include real estate, equipment, intellectual property, and inventory. And so they represent productive capacity of corporations, and we look at it on a per capita basis. And the indicator is the year-over-year percentage change in the productive assets that corporations are putting to work, which is shown by the blue line. The red line shows the actual federal funds rate, and they are both on the same scale, and you can see how closely it actually tracks the federal funds rate. It's a very simple indicator, yet it's remarkably predictive of the federal funds rate. And it makes sense if you think about it, because if companies are adding to their productive capacity, it implies positive growth and growth expectations, and the federal funds rate matching that is consistent with the Fed actions of trying to moderate the pace of growth. The fact that it matches up on the same scale as the federal funds rate seems almost coincidental. So this is what the Taylor rule looks like compared to the federal funds rate. It's a pretty good indicator. If you are not familiar with it, it adjusts the interest rate to changes in output and inflation, but requires assumptions regarding the output gap, target inflation rate, and the natural rate of interest. And then here is our measure versus the Taylor rule, and they are pretty similar, but the thing is that our rule does not require any assumptions at all. So that was the first measure. The second measure we look at is the gross value added of those same non-financial corporations, which represents the top line revenue. And this chart is the year-over-year percentage change in gross value added versus the change in the federal funds rate, and you can see that it also has a pretty good correlation with the federal funds rate. They were on different scales, but they generally move in the same direction. Note the declining trend since 2011 in our measure. Now it gets interesting when we combine the gross value added with the productive assets to get a sales to assets or asset turnover ratio. This is what that looks like also against the federal funds rate on different scales. They also move in lockstep on different scales, but what is interesting here, if you look at the left side scale, our sales to asset turnover ratio is 68%, which is actually lower than it has ever been in history besides the last recession. So we are not getting as much juice out of our productive assets as we used to, and it makes it harder for companies to make a profit if they are not turning over their assets sufficiently. So there is some definite weakness in this ratio. Before we show how it tracks the federal funds rate, note how the year-over-year change tracks nicely with the Chicago Fed National Activity Index, the CFNAI, which is a broad measure of economic activity comprising some 80 different indicators. So our simple indicator does a good job here too. Recently there is some divergence where our indicator is showing weakness even though the CFNAI has been flat. And so this indicator showing the year-over-year change in the asset turnover ratio is the key indicator. This is the same chart we just looked at, but compared to the change in the federal funds rate. And this is very interesting because you can see our measure for the most part actually leads the federal funds measure by 1 or 2 quarters. So it's pretty predictive of the change in the federal funds rate. Correlation actually improves when we lag the federal funds rate by 1 or 2 quarters. And so this is a very valuable indicator to keep track of and is the highlight of this presentation. It's been declining since 2011. There is some weakness there, and even though the federal funds rate has been flat, our measure is showing some weakness. So that is interesting. And next we will look at how this indicator tracks capacity utilization, unemployment, and inflation. Here is capacity. You can see asset turnover ratio has been declining in line with capacity utilization. It makes sense. We are just not utilizing as much of our productive capacity as we used to. Unemployment, here is the same ratio compared to the unemployment change. And here we have a pretty strong negative correlation. When our measure is going up, unemployment is going down, which makes sense. If the economy is growing, unemployment is going down. And recently, unemployment is still improving, even though our indicator has been showing weakness. So we don't know if the employment situation is a bit tentative or whether the sales measure will pick up and rectify that relationship. This is the change in our same asset turnover ratio versus inflation expectations. And this is just using the difference between the 10-year nominal bond and the 10-year inflation-protected bond. The data on this only goes back to 2004, so that's pretty good so far. When we look at it compared to data from the Cleveland Fed, which actually calculates 10-year inflation expectations going back to 1982, it still looks pretty good. And then this is the change in each of those. The correlation is not as strong as with unemployment, but it's still 40%, so they generally move in the same direction. In other words, when our indicator is growing, inflation is going up, and vice versa. So you can see that this measure syncs with all the variables that the Fed looks at. It gives a real good perspective of what's going on in the economy. Just to sum up, the Fed has allowed growth to go on without a federal funds rate raise for longer than would have been predicted by our productive assets indicator. However, the growth of those assets occurred without a matching increase in top-line growth. Combining the two measures shows a low and declining asset turnover ratio and highlights the issues we have with capacity utilization, employment, and low inflation. Unemployment and inflation are now close to target. However, the asset turnover ratio is signaling weakness ahead for sales, which in turn will affect unemployment and inflation. So this presents a real predicament for the Fed, and it makes sense why there is such division within the FOMC right now. It's just not a clear picture. Thanks.